Good afternoon, and thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is IMI, who released their half-year results on the 1st of August. We're delighted to have with us today Edward Hann, the Head of Investor Relations, and I'm going to hand over to Edward to start today's presentation.
But yeah, thanks, Alex, and yeah, of course, thank you all for joining this afternoon. It's a pleasure to have you all here. So as Alex said, I'm going to start with a quick recap of our first half results, cover a bit on the strategy, and then we can move to questions and answers. So the first thing to say is that it was another good performance in the first half. We delivered 2% organic sales growth and 5% organic adjusted operating profit growth. Adjusted operating margins were up another 30 basis points, and we delivered £64 million of orders through our Innovation Accelerator Growth Hub. The £200 million share buyback we announced in February completed in July, and we increased the interim dividend by another 10%, which reflects the continued confidence that we all have in the business. So with the completion of this buyback, I'm very pleased to announce that we have now returned over £1 billion of capital to shareholders since the start of 2019. Our transport sector was placed in a strategic review in May. This process is progressing well. The sector team are developing a detailed plan to accelerate improved financial returns, and we continue to assess all strategic options. Now, there's strong momentum in IMI heading into the second half, and we are very pleased to be reconfirming our guidance for 2025. We are on track to deliver our fourth consecutive year of mid-single digits organic revenue growth. We continue to expect that full-year adjusted basic earnings per share will be between 129 pence and 136 pence. So, as I said, we are very, very pleased with the performance in the first half. Revenue increased by 2% organically. Adjusted operating profit was up 5%. Our adjusted operating margin increased another 30 basis points. The adjusted basic earnings per share were 3% higher than the prior period, as adverse currency and tax rate movements were offset by the reduction in outstanding shares due to the buyback. Operating cash conversion was very, very strong, and we are pleased, as I said, to be increasing our proposed interim dividend by another 10%. So on this slide, you can see a bit more detail about our revenue and operating profit performance. So we delivered 2% organic revenue growth, but largely due to a weaker US dollar, our statutory revenue was slightly lower. Adjusted operating profit increased to 198 million. Organic profits increased by 5%, which again was offset by foreign exchange. So looking at the detailed income statement on this slide, as mentioned, we saw good growth in revenue and operating profit in the half year. The net interest charge was broadly in line with last year at £8.6 million, despite the share buyback, and the adjusted tax rate increased from around 24% to roughly 25%, in line with our guidance for the full year. Now, as some of you may have been aware, IMI was subject to a very serious cyber attack in the first quarter. Thanks to the incredible efforts from our people, supported by industry experts, we were able to limit the impact of this attack to temporary operational disruption. The second quarter organic revenue growth of 6% reflects the catch-up on sales that we expect to complete in the second half. As expected, we have recognised a one-off exceptional charge of £25.4 million in the first half, which covers IT systems recovery, risk management, upgraded IT infrastructure, and advisory costs. Now, looking at the performance of the platforms and the sectors, which was very much in line with our expectations. So starting with automation, automation delivered good growth, with revenue up 3% organically, and margins in line with the prior period at 18.4%. Process automation had an excellent first half, delivering strong order intake, as shown at the bottom of the slide. Adjusting for the one-off marine order last year, orders were up 7% organically, with particular strength in power and nuclear. We made further progress in the high-margin aftermarket, where organic orders were 10% higher than last year. Organic revenue was up 8%, and the order book was up another 5%. Industrial automation organic revenue was 4% lower than the same period in the prior year, reflecting the one-off impact from the cyber incident and softer industrial activity in Europe and the Americas. The business is rebuilding momentum. It was flat organically in Q2 and will benefit in the second half from further catch-up shipments impacted by the cyber incident. So turning to Life Technology, as expected, organic revenue was 1% lower than the prior year. However, margins improved by 80 basis points to 17.8%, supported by the final benefits from our footprint optimization initiatives. Climate Control delivered another strong performance in the first half, as we saw continued demand for our products that reduce energy consumption in buildings, including the benefit from our growing portfolio of smart connected products. Organic revenue was 5% higher than the prior period. In Life Science and Fluid Control, organic revenue was 5% lower than the prior period. Now, the Life Science sales were only slightly down in the first half, with good order intake and a book-to-bill in H1 of 1.1 times. The Fluid Control sales were more impacted by the cyber incident, but is recovering well and has a strong order book heading into the second half. Transport revenue was down 9% organically in the first half, and this was in line with expectations, given the 13% organic growth delivered in the first half of 2024. So as mentioned, with the completion of our £200 million share buyback, I'm very pleased to report that we've now returned over £1 billion to shareholders since the start of 2019. This has been supported by significant improvements in our free cash flow, and as you can see on this slide, we see a clear pathway to delivering further improvements. We expect to deliver over £1 billion of free cash flow over the next 3 years, supported by further growth and the normalization of working capital. We have an extremely disciplined approach to deploying this capital, prioritizing investments in our people, processes, and operations that accelerate organic growth. We will also pursue bolt-on acquisitions that enhance our position in attractive long-term growth markets and deliver returns in line with our strict financial criteria. Finally, we will continue to deliver returns to shareholders. We are absolutely committed to maintaining a progressive dividend, and we will look to return capital to shareholders should leverage fall sustainably below our 1 to 2 times net debt to EBITDA target. At the end of the first half, net debt to EBITDA was 1.4 times, towards the midpoint of that range. So, as I mentioned, we are on track to deliver our 4th consecutive year of mid-single-digit organic revenue growth in 2025. We continue to expect that full-year adjusted basic EPS will be between 129 pence and 136 pence. And our guidance assumes that the full-year adjusted operating margin will be around 20%, and that interest charge will be slightly higher than our previous guidance. The tax rate is still expected to increase to around 25%, and we expect that the weighted average number of shares will reduce to 249 million at the year end. We are assuming that exchange rates will lead to a 1.5% headwind to profits in the full year, but we'll be keeping a close eye on how this develops in the second half. So before we head into the Q&A, I'm going to provide a quick update on IMI strategy. So IMI is a global leader in fluid and motion control with a compelling value proposition. Our solutions typically represent a small part of the total system cost, but can have a significant positive impact on end customer outcomes. This drives growth, customer loyalty, and strong pricing power. And we are well placed to support our customers in the attractive aftermarket. Our business is aligned to 3 long-term structural growth trends: automation, energy efficiency, and healthcare demand. And we see these powerful drivers supporting the delivery of sustainable, profitable growth. And all of this is underpinned by our One IMI operating model. Now, this One IMI operating model is a proven platform for value creation and sustainable growth, designed to deliver our financial framework. By applying a consistent approach rooted in commercial excellence, market-led innovation, and continuous improvement, we are creating significant value for shareholders. So commercial excellence remains at the heart of our strategy, and we are focused on creating ever more value for our customers through premium service, technical support, and disciplined sales execution. We've significantly improved customer satisfaction, and we leverage these relationships to co-create high-value-add solutions. And all of this is supported by significant investments that we've made in our people, our processes, and our operations, including data and digital, which I'll be touching upon in the next slide. Our unique market-led approach to innovation is creating real value, grounded in deep customer insights and executed through our entrepreneurial growth hub model. We develop solutions that address industry-wide problems and then leverage our strong customer relationships to gain a deep understanding of our customers' needs before moving at pace to validate those solutions and full market potential. Through this process, we were able to minimize upfront investment before rapidly bringing validated solutions to market once customer endorsement has been fully secured. We delivered £64 million of growth hub orders in the first half, and we have a strong pipeline of opportunities across IMI. As I mentioned, we will also pursue attractive bolt-on acquisitions, and since 2019, IMI has been strengthened by 6 complementary value-add acquisitions, while our fully burdened return on invested capital has increased to 13.4%, significantly higher than our 12% underpin and our weighted average cost of capital. Finally, with our multi-year restructuring program now complete, our focus is now on continuous improvement. While IMI now operates from a leaner, stronger platform, we will continue to identify programs that improve efficiency, reduce complexity, and better serve our customers. Restructuring costs associated with our current business are now being taken into underlying operating profits. So I also wanted to spend some time sharing a few examples of how we are executing our One IMI operating model across the business. So firstly, our investments in data and digital are accelerating high margin aftermarket growth. Now, from the hard work of our process automation team, we have built a full database of over 200,000 valves in our installed base worldwide. Using this database, we are able to identify key aftermarket opportunities and prioritize our sales efforts. And we estimate that this has had at least a £70 million positive impact from this initiative alone on our order intake over the last 2 years, with much more to come. Secondly, the excellent progress we have made expanding our range of smart connected products. Smart connected products now make up roughly 25% of climate control, and there is a growing demand for the precision, the insights, and the convenience that these solutions offer. In March 2025, we launched a new electronic thermostatic radiator valve that leverages our heat miser technology and can be controlled via an app. This is an incredibly exciting opportunity and presents us with a significant opportunity to scale across our European markets and over 200,000 homes in the heat miser ecosystem. Finally, we are focused on driving excellent customer service and productivity through continuous improvement. In industrial automation, we win in highly customized applications where fast response to customers is absolutely crucial. There is lots of great work across the sector, and our Rockford facility is an excellent example. The team have built a digital twin of the site to facilitate layout simulations and optimizations in real time, drastically reducing lead time to customers and improving flow. Now, underpinning all of this are our people and culture, and we have put a lot of effort into building a culture of ownership, a culture of accountability, and a culture of customer focus. And this has played a key role in IMI's transformation over the last 6 years. And as you can see on screen, it has played a key role in a significant increase in productivity. We are focused on embedding a performance-driven mindset, and we have made significant investments in our people to help them grow, develop, and continue creating significant value for customers. We are committed to targeted development at every level, and we've launched a range of new training programs in the first half. We also ensure that our top talent regularly moves across the group, enabling us to leverage best practice and develop the next generation of leaders. Another key driver of significant productivity improvement is our absolutely relentless focus on continuous improvement. A great example of this is our facility in Brno in the Czech Republic, where they identified over 600 improvement initiatives in the first half of this year alone, and they continue to reduce complexity and improve customer service every single day. All of this is supported by employee engagement, and we are very, very proud to report that 79% of employees would recommend IMI as a great place to work in our recent survey. So as you can see on previous slides, IMI has been fundamentally transformed over the last 6 years. We are executing the growth strategy, and we are on track to deliver our financial framework. As a reminder, we want to deliver 5% organic growth, operating margins at 20% plus, cash conversion above 90%, and maintain our fully burdened return on invested capital above 12% as we continue to create significant value by supplying our capital both organically and into targeted bolt-on acquisitions. Now, it's clear that this growth strategy continues to deliver great results. As you can see on this slide, we've built a track record of performance, and we are compounding profitable growth. Adjusted EPS has grown at 11% CAGR since 2019, and we expect further progress in 2025. So, to summarize the final slide before we head to Q&A, the key takeaways. Firstly, that our growth strategy continues to deliver great results. Organic revenue grew by 2%, adjusted operating margin was at another 30 basis points, and our adjusted operating profit grew by 5%. Second, there is great momentum within our business as we head into the second half, and we are on track to deliver our fourth consecutive year of mid-single-digit organic revenue growth. Third, and finally, we are reconfirming our EPS guidance range. We continue to expect that this year's full-year adjusted basic EPS will be between 129 pence and 136 pence. Okay, with that, I am going to hand over to Alex for the Q&A. Thanks all.
Great. Thanks for that presentation, Ed. Good to see IMI performing so well again. I see the shares have responded. They're up 20% this year. Not surprising, really, given that performance and obviously the very positive outlook. So, look, thank you for presenting that today. As Ed said, we're now going to take questions. And if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. So let's see what we've got here. Let's start with the first question. Can you talk about how the company is thinking about tariffs?
Yeah, it's a really, really good question. And yeah, clearly very topical. So it's been a bit of a moving picture in the first half, and the team have worked very, very hard to mitigate their impact. So as I say, we've done, broadly speaking, three things. So firstly, we have leveraged our global footprint. So we've made sure that anything that was previously going to the States that perhaps didn't need to has been rerouted. Secondly, we've spent a lot of time, and trust me, there's a lot of paperwork here, going through all of the exemptions for our goods. And yeah, it's been tremendous effort from the team. And third and finally, we've looked to leverage our strong pricing power to kind of pass through that impact to customers. So we'd estimate that the first half tariff impact on IMI was about £4 million, and that was passed through. And we expect the impact in the second half to be broadly double that, so around £8 million. So yeah, considering we generate about over £2 billion of revenue each year, it's not the biggest impact, but doesn't quite reflect the tremendous effort from the team that's gone into managing it.
Thank you. Next question here. Are you seeing more demand in nuclear applications?
Yeah, definitely. Right. So IMI, our process automation division, specializes in energy, oil and gas, power, defense, and we have a very, very strong reputation in the nuclear business. Now, there's probably roughly 80 to 100 million pounds of sales into nuclear each year, and for the last few years, that has pretty much been solely aftermarket because there are not that many new nuclear plants being built. However, that being said, we have seen signs of life over the last few years. I think that's principally driven by the need for more electrons in this world, right, to power all our EVs and all the data centers that people are talking about. So in the first half, we did actually win a new construction order on kind of Sizewell C in the UK, which was really, really great to see. And we're also very, very well positioned when it comes to development of the new small modular reactors. And we do see an opportunity to deliver between around 3 and even 20 million pounds of content per SMR. And that's actually leveraging a lot of the relationships that we have through our work on nuclear submarines over the last few decades. So yeah, really, really well positioned and excited to see what happens next.
Okay, thank you. Moving on to a question on valuation now. How should we look at the 17 times PE valuation multiple against the mid-single digit EPS growth? Does that look a little bit expensive to you?
Yeah, that's a good question, Alex. So I think hopefully you'll remember the slide which I showed earlier that kind of shows that our EPS has been growing at an 11% CAGR since 2019. Now, even though the share price has performed very, very strongly over the last 6 years, I think this is broadly in line with that EPS growth, if I'm being honest. So the multiple is it's kind of broadly unchanged with what it was in 2019. So it doesn't really reflect the significant transformation that we've been on at IMI. So as you remember in the slides, customer satisfaction has gone from being about a score of 10, which is all right, not amazing, to being 50 plus. We now have an innovation engine growth hub, which is delivering real results, £149 million of orders last year. And we've been through a significant restructuring program, closing about 20 sites over the last 6 years, increasing margins by 550 basis points. So I think even though the share price has performed well, I don't think that multiple fully reflects the transformation that the business has been on. And there is still, still a bit of a gap in the valuation, some of the UK peers and the US peers as well. So that's how I respond to that.
Thank you. You put up a slide earlier which showed £1 billion of free cash flow over the 3 future years. Could you give us the numbers for what free cash flow will be in each of those years of 25, 26 and 27?
Yeah, I can't give you the exact numbers, but I can give you some commentary on how it's likely to move, right? So IMI remains highly cash generative. And kind of as you said, Alex, we expect to deliver over £1 billion of free cash flow over the next 3 years. So what I'd say is that if it wasn't for the cyber incident this year, we would have been around £300 million. So we expect to show some growth this year, but I don't think we'll be getting up to the £300 million level. And then we will show further growth in the next 2 years, driven by 3 main things. So the first would be the non-repeat of restructuring costs. So as I mentioned, over the last 6 years, we've been on a multi-year restructuring program where we've closed 20 sites. And to do that, we've been investing around 30 to 40 million pounds a year. That program is finished now, so you're not going to see the repeat of those costs, which will clearly drive a step change in cash generation. Alongside that, you'll also see some working capital start to normalize, because as you are closing these sites, you need to build safety stock to make sure that you continue to serve customers. Now that program is finished, we'll be unwinding that safety stock. And third and finally, don't forget, we expect the business to keep growing if we deliver that financial framework. So you should see nice operating leverage in the business. So we'll get to that 1 billion, I think, over the 3 years. And we'll continue to progress as we go forwards.
Great, thank you. You mentioned the cyber incident and its cost on the business in the first half of the year. There's a question here as a follow-up to that, which is there an expected impact from the cyber incident in the second half on revenue, cost or assets? And on the cost side, has everything been provided for?
Yeah, so unfortunately, it's not uncommon now, right? But IMI was subject to a very serious cyber attack in the first quarter. Thanks to the tremendous effort from all our teams, right, supported by the external experts, we were able to limit that to kind of temporary operational disruption. But it did impact our performance in the first half, and obviously you have that kind of £25 million cash outflow. But I'm pleased to say, right, we are back up to normal operations now, and you can kind of see that the growth in Q2 of 6% organically reflects the catch up on sales that were kind of delayed. Now there still is a bit of catch up to come, particularly in industrial automation and fluid control, as we work through the backlog of orders that have kind of been delayed due to that incident. But it's more around kind of sales that we're catching up on in H2 rather than anything else. But I say thanks to the tremendous efforts from the team, it was limited to kind of broadly kind of 10 days of disruption.
Okay, we've got 2 sort of follow-up questions that have come on that cyber attack, and I'm going to sort of ask them together so that you could cover them together. The first one is, what systems have you put in place following the cyber attack? And the second one is, what were the key learning lessons from the cyber attack for yourself and for other companies?
Yeah, so we do, like, we invest in state-of-the-art tools, and we have a very, very experienced team here, right? But unfortunately, you're only as strong as your weakest link, right? So as I'd say, what we're doing now going forwards is, one, we are spending even more money training our staff to make sure that people are aware of the risk. People are, not clicking on links and emails. People are aware of the sort of techniques that bad actors might use to get into the organization. So that's number one. Secondly, we've pretty much doubled the size of our cybersecurity team now, and making sure that they are equipped with all the latest tools as well to kind of follow up on all these incidents. And linked to that, I guess we are investing in more and more levels of security, ultimately just to make sure that we are the hardest door to knock on. So I think we're doing a lot to go forwards, but I think sadly it's becoming commonplace in the markets at the moment. But I think we're moving in the right direction and moving very, very fast.
Thank you. Another area which is being flagged quite regularly is AI, and we've got two questions on that. And again, I'm going to ask them together. The first one is, how are you embracing AI? And the second one is, how are you using AI to improve your business? And does the growth in AI provide you with any benefits?
Yeah, it's a really, really good question. And I'll answer them together, right? I'll talk about the direct impacts to start with, and then the indirect impacts from AI as well. So as to how we're using it internally, absolutely embracing AI, obviously cautiously thinking about the kind of data protection risks, but some really, really interesting applications. We have our own kind of AI chatbots, which our salespeople, engineers can use to find out information about products should they need it. We are using it to help our sales team extract information from kind of fact sheets to kind of speed up the quoting process. And probably most materially is the example I alluded to in the presentation, right? So in process automation, we have over 200,000 valves installed globally. And we have a database that is built up of all these valves, and we can track the amount of revenue in kind of parts, upgrade services they are generating each year in the aftermarket. Now, using AI, we have been able to analyze that data set and identify which assets are perhaps not generating the benchmark level of service, parts, upgrade revenue, which is really, really high margin. And then once you've identified those opportunities, you can make sure that you are directing your sales force to go and follow up on them. And as I kind of alluded to earlier, we estimate that's had at least a £70 million impact on our order intake over the last 2 years, with a lot more to come. So quite material now, really, and a great example from the data team that we have here. And kind of as for the kind of indirect impact from that, I guess what I would say is that I'm sure you've read about it, but using AI, the data centers that are then used to kind of power the AI searches that we're all doing require a tremendous amount of energy. And I think, clearly about 10% of IMI is linked to conventional power, and then you have the nuclear business on top of that. So as we need more and more energy to power those data centers, the indirect impact in terms of demand for our products could be really, really good.
Thank you, Ed. Got a couple of questions here on the M&A and the M&A pipeline. And again, I'm going to ask them together. Firstly is, what does the M&A pipeline look like? And then secondly, any update on the M&A front? Are there any interesting acquisitions out there? What's happening to prices?
Yeah, it's a good question. And as kind of talked through in the slides, IMI is highly cash generative. So we've made sure we've got a very, very clear framework as to what we want to do with that cash. So I guess the first priority is obviously investing in the core business to grow organically. So investing in people, investing in tools, investing in training. That's the number one priority. And then, of course, we are going to pay the progressive dividend. And that's something we're absolutely committed to. And then after that, we would love to unlock smaller bolt-on deals. So these might be small companies that have interesting technology that we can bring into IMI and scale across our relationships with customers, our installed base, or they might be a business with a significant installed base of valves out there that perhaps is underutilized. So similar to what I was talking about with AI, we could go in and mine that and really optimize the sale of the high margin aftermarket products. However, we are extremely disciplined. We are not going to overpay for these deals. We want to make sure that they are delivering returns in line with our weighted average cost of capital, which is about 9% by year 3, and returns that are not dilutive to our group return on invested capital, which is about 13% by the end of year 5. Pipelines do remain very, very strong and very, very healthy. But to the point on price, I would say, particularly in markets where, kind of activity might be a bit depressed at the moment, vendors who have a quality asset are likely to trade through it. They're not going to sell their business for a multiple of depressed earnings. If somebody told them that their business was worth £150 million 5 years ago, they'll still want £150 million now. They're not going to sell it at a discount. They'll trade through. But we're absolutely committed to building relationships, getting out to trade fairs, and getting our sector teams out there as well to build the relationships. So, lots of interesting opportunities out there. And clearly, if we can't unlock those deals, we will return surplus capital to shareholders, like the £200 million buyback that we completed in July.
Great. I'm going to ask this question. I think you covered all the points. It's another one on the M&A, which is, given the cash situation, are the M&A team active currently, or are there alternative allocation opportunities being considered?
Yeah, I mean, the team are active, and so are the sector presidents as well. So we want to make sure they're involved in the process. They're out there at the trade fairs, getting to know people. But as I said, we're not going to overpay, right? So if we can't find those deals, we will return capital to shareholders. And it comes back to the first point, right? But given the valuation that we trade on at the moment, I think that will be most likely via a share buyback. So we're certainly not going to sit on cash. If we fall sustainably below that 1x, we'll return it to you all.
Thank you. I have a question here on operating margins. The FY24 operating margin was 19.7% and HY25 margin was 18.2%. Why is there so much difference between the half one, half two margin split?
Yeah, that's a really, really good question, and a good observation as well from whoever submitted that. I'll say that's pretty typical for IMI, and you'll see last year, H1 2024 margins were 17.9%, but the full year they were 19.7%. And it is principally driven by the seasonality in volumes in our business. So particularly in process automation, which is 40% of the business, we see more volumes going through our factories in the second half, and particularly in December, which means our factories are busier, and the margins are a lot stronger because you've kind of got more contribution to cover your fixed costs. In the first half of the year, volumes might be a bit lower, so the margins will be lower because there's less to cover for those costs. So it all kind of comes down to operating leverage. But I'd say that is typical of IMI. And if you look back in history, you'll see a similar kind of pattern each year.
Okay, thank you. And the last question we've currently got, so look, a quick reminder, if you do want to ask a question, please type it in. We've got a few more minutes. But anyway, the last question currently in is back to AI. Is AI slowing recruitment of replacement staff as employees leave or retire?
No, I don't think so. I think we view AI as, the business is growing, right? And AI is a key enabler to help our staff become more productive. So I wouldn't say it's slowing down recruitment at all, really. And probably worth remembering that obviously we're an engineering business. We employ 10,000 plus people globally, and a lot of those people will work in our facilities, kind of designing, developing, engineering. But I'd say AI is helping them become more productive, not replacing them, right?
Great. Thank you, Ed. There are no further questions that have come in. So before we exit, would you like to just say a couple of concluding remarks before everyone leaves today?
No, thanks, Alex. And thank you all for dialing in. I'd say another great performance from the team in the first half. We're very, very proud of it, particularly how we reacted to that cyber incident. And I think the catch-up growth, kind of 6% in Q2, really reflects how quickly the business came back. In the longer term, we touched upon the valuation, but I'd say that IMI has been on a significant transformation over the last 6 years under Roy's leadership, which are delivering significantly improved financial KPIs. But underneath that, we have a business that is now serving customers much, much better, is innovating, and operates from a much leaner, stronger platform post the restructuring program. And I don't think that transformation is really reflecting the valuation yet, even though the share price has remained strong. Thanks very much for dialing in all. And if you have any follow-up questions, feel free to reach out. We're always happy to help.